is your Thursday edition. Getting near the tail end of January. I'm excited for this one. I'm happy that as goes January, so goes the rest of the year. We can finally put that to an end and see where we stand. So I hope you all had a great day out there today. We are going to talk a lot about the bond market today, interest rates, and really the fireworks, or as many say, the lack of fireworks at Jerome Powell's press conference on yesterday's session. So we'll talk about that. My guest, as you guys know, is I call him the Bond King. It's funny, there's another guy that actually tried to get on the program once. He calls himself the Bond King, but he's not. Bill Addiss is the Bond King. So here's our graphic for today. The bond market update with Bill Addiss. He's going to be joining us, I'm sure, certain from the East Coast. So Bill, how you doing today?
I'm doing wonderful, and it's always a pleasure to be with you in the audience here. Good afternoon.
Good afternoon. We talked a little bit about the show a little bit before the show today. Over the years, I used to not watch the press conferences, of the FOMC meetings. It was kind of like, okay, whatever, I'll just get the Cliff Note versions. Now, it's like I want to grab a bowl of popcorn and just sit there and just chomp away and watch and go, oh, God, that was a stinger of a question. Yesterday's was a snooze fest. I mean, there was three things that were addressed that I kind of felt that was going to come up no matter what. And other than that, there was no real clear direction. Was there anything that stood out from your perspective with regards to what Powell presented yesterday?
No, and I have to reiterate what you said. It was boring. What I love doing is the way Bloomberg sets it up is as Powell is talking, they're running the S&P and Dow. So, it's almost like the EKG of what's being said. Yeah. And you can get some real volatile depending on how he, says an adjective or an adverb. Yesterday was just boring. There was no surprises. There was no, but I do think we have to understand that the reason for that is there is no clear lack of conviction yet. Powell isn't kidding when he says this is all data determinant. So they don't know what the next move is because there's so much in flux right now. So I think he did a good job of kind of maintaining a stability in the choppy waters that we're experiencing. I really do. I think the calmness in and of itself was the success of the meeting.
Well,
because things are going to get choppy out there.
They are. Yeah, he's not even winded from taking his victory lap, right?
Exactly. And now the president is apparently, avoiding them. They haven't spoken even. I thought that was interesting. Interesting.
Do you believe that?
I don't think he would say it if it wasn't true, quite frankly. I think he would just keep mum on the topic. So, yeah.
Well, he was being pressured. I know Steve Leisman asked him 3 times, what the press. It's funny because I was saying that I do Monday morning must knows for Trading Academy. And one of the things I said is I can pretty much guarantee you're going to get the question of, President Trump is demanding rates go lower. What's your thought on that? And of course, it was the first question that came out at the meeting by Leisman. And he says, he pressed him again and he said, I haven't talked to him at all. No comment. And I would find it hard to believe that the new president, who is adamant about interest rates dropping, doesn't talk to the guy who's responsible for those rates. And it's the guy that you appointed, so you should have some rapport already with him.
Some dialogue, exactly.
Yeah.
Exactly. Yep. But I also have to point out, and I think part of that is because of the duality of the message going on. I mean, let's face it, the topic that we're all interested in is tariffs. Mm-hmm. How much, when, who, and all of that seems to be in flux literally every day. So when the Fed talks, he did say we're poised to respond to a variety of different potential scenarios out here. Again, I think he was trying to offer that voice of sanity in the woods. The reality is that we don't know what's going to happen. But if there are tariffs, and that obviously appears to be a major discussion, that is inflationary. Yeah. So you can't put on an aggressive tariff strategy and then turn around at the same time and say, I want rates to go down.
Yeah.
That's counterintuitive. And maybe Powell doesn't want to have that conversation with him. But, the costs are going to get passed on to somebody. Tariffs are inflationary, whether we want to admit it or not. And that is not an environment where the Fed's going to continue to drop rates.
Right. Yep, absolutely.
It's not politics. It's just economics.
It's economics. And it's funny because today, obviously the FOMC statement was yesterday, and we got Powell's thoughts. We'll talk about unemployment and things like that and inflationary pressures. Today, he said, because of the fentanyl, I'm tariffs on Canada and on Mexico of 25% tariffs. There you go. And I always make this point that he is a showman. Ever since I saw him I've only watched 1 or 2 episodes of that, whatever he's the Apprentice or whatever that garbage show was. And right as you're about to go to a commercial break, he would say something so astounding that you're just going, no way. Oh my, I have to watch, right? I have to watch. So guess when these tariffs go into effect? Saturday, they go into effect. Of course, over the weekend when the markets are closed. So what will probably happen is we got the shock factor today. If you saw the U.S. dollar, Canadian dollar, U.S. dollar surged on that announcement. My guess is by this weekend, no tariffs are going to get put into place. It'll be like, no, we came to an agreement. They're gonna force the borders a little bit more. You gotta love the shock and awe from Mr. Trump.
Exactly. How much of this is marketing? How much is hype? How much is a negotiating tactic? And there is legitimacy to that. But bottom line, until we know what we're dealing with, the markets are going to be kind of frantic here or frenetic here. There's going to be choppy waters, as I said. But I think we've learned that, the first how do I say this diplomatically? President Trump's first words about tariff imposition are not the last word. Yeah. There's a lot that happens.
Yeah, absolutely.
Yep.
You talked a lot about in the past about the repo rate, and has there been a change there with regards? Because I heard some stuff about negative repo rates and just issues there. Anything that's noteworthy to share with our audience?
Yeah, there's a couple things. One is to explain, and so as we all know, yesterday there was no change in terms of Fed funds rate. The Fed is on pause at the short end, having dropped him by 100 basis points. But there are some things going on in the market that warrant attention, and the first is that the Fed is continuing to taper. Tapering is the opposite of easing.
Yeah.
So they were bringing rates down, but at the same time they were easing, they were also initiating a rather aggressive tapering program. And tapering simply means they're destroying money. They're literally physically destroying money. At the height of it, they were destroying $120 billion a month. As of now, we're down to $60 billion. And they're confirmed that there'll be $60 billion kind of on an ongoing basis until they say otherwise. And many people I hear are talking about third quarter next year. They'll continue to destroy money until then. But that's not from the Fed. The point is the Fed is doing this tapering. So they've got, they're destroying liquidity in the U.S. market. And that's what we want to do. That's something that is a benefit. We've talked about it. We've got too much money in our economy. It's literally sloshing around. You've showed the charts of M1 that none of us believe. The Fed's balance sheet. We're swimming in money. But thanks to these tapering actions, that money is starting to become more scarce. And that's what we need and want. And that's what's being reflected in the repo market right now. At one point, the large asset managers were afforded the opportunity to do repo. This was something they'd never been afforded before. This was a monetary tool added during the pandemic. And the firms stepped up and were doing $2 trillion a night to get all this excess cash, earning them some interest. And that's what the Fed wanted to do. They achieved it. But now, as the liquidity is starting to dry up, less and less firms are taking advantage of it. They've had some nights where it's only about $100 billion a month, a night, which is minuscule. Now, the mechanism by which they do this borrowing and lending is what you're referring to as the repo market. The repo is the product that we use to lend money to the Fed. And it's a one-day, overnight, very safe transaction. But that repo market is kind of drying up.
Right.
Because the firms aren't sloshing around with cash like they were. So that's good news. And some people are talking about, I was on a conference call with a group of economists I like, and they're saying that although this was only introduced during the pandemic, the Fed probably is going to be quick to shut this down as soon as they feel comfortable, because they really don't want to be in the business of dealing with the investors directly, even though it's institutional investors. So we'll see. But in the meantime, your audience is benefiting because that's where they're getting such a good return on their money market funds.
Yeah.
It's because the money market funds are investing in this repo product with the Fed, more so than any other trade.
Yeah. Well, we can always look at things from the double-sided sword here. And while I would agree with you, it's great that we're taking some of this money out of circulation, because one of the things that always cracked me up, especially over the past few years, is people always point the finger and say, well, Biden screwed up or Trump screwed up and they created inflation. Look, it wasn't any one of them individually. It was the printing of money that was the lion's share of inflation. So by removing this money, that in theory should take some of the pressure off of the inflationary cycle. Now that sounds great from consumer prices. However, if we remove money from supply and the same amount of people are looking to buy dollars, which is what's happening, I think demand is actually increasing.
Right.
That drives the price of the dollar up, which is why you guys saw the dollar chart I have here. Since October, I mapped this one out to where we are right now. The dollar index, which of course is against a basket of securities, is up about 8% in the last 87 days, 87 trading sessions. So not horrific, but if in fact they do continue to retire, as Bill pointed out here, and I'll bring up the chart for you guys, you're talking $60 billion a month taken out of circulation. Now, when we're talking about trillions, this is a drop in the bucket, but every billion that gets taken out starts to add more pressure to the upside. So, in my thinking, Bill, when I'm looking at this chart here of the dollar index, knowing that the Fed is going to be retiring money, the high probability trade for me is that this trend of the dollar getting higher and getting stronger will continue. Would that be
Absolutely.
Yeah?
Absolutely. And you can add American exceptionalism to it, because we really have come back from the pandemic so much stronger than most other economies.
No.
So if you look, European Central Bank, perfect example this morning, right? They cut rates by 25 basis points.
Yeah.
They're easing because the economy is not good there. Our economy is not suffering, right? GDP at 2.9% this morning. American exceptionalism really is legitimate. Our Fed decided we were going to spend our way out of the pandemic, right? We were going to print up lots of money. Government was going to give us handouts. The Fed gave us handouts. We were going to literally consume our way out of the pandemic. And it worked.
Yeah.
It absolutely worked, without inflation being the rampant problem that many of us, myself included.
Yeah.
I thought inflation was going to be worse than it was. That's why I say it. You alluded to it. I've been saying for the last month, I think the Fed is entitled to take a victory lap here. We dealt with an 18-month inverted yield curve and never got the recession that every other inverted yield curve has predicted.
Wow.
They did that magical soft landing.
Yeah.
I think they're entitled to take a victory lap.
All right, we'll let them take their victory lap. And who knows how long that victory lap will be. And the reason I say that is, when you have exceptional dollar strength, it does start to wear on an economy at some point. Now, again, I'm not saying that this is not trying to be, doom and gloom, but a very strong dollar can hurt an economy, right? It really reduces anybody who's got international business. It hurts them, because if they try to take those those euros and repatriate them back into dollars, you're not buying as many dollars, right? So it starts to hurt you.
Absolutely. Exporters get hurt.
Yep.
Absolutely. Yep.
We'll see how that one pans out ultimately.
We'll see how that one plays.
Time will tell. And at the end, I'll just have you thinking here. I know that you're not a Bitcoin fan, and I know that you are the bond king, but I do two forecasts on this program, the SPX and Bitcoin, for the end of the year. And at the end of the show today, you can just guess if you have to, because you might win a prize. I've got some Trader Merlin gear for you. As Lisa says,
where are you putting SPX at the end of the year?
I've got it on the list here, but I think we're going to be. Well, I don't want to ruin it for you. I'm not going to. I will wait for your guess, and then I'll guess your estimate.
Here's my issue, Merlin. I have discovered it's good for me to stay within my wheelhouse.
Yeah.
I mean, I have expressed to you, I don't understand the equity market. When we were going through the pandemic, and even last year we hit 67 record highs on the S&P.
No.
I'm not seeing an economy that is at pre-pandemic levels. So I truly will confess, and I say this not sarcastically, I don't understand the equity market.
Yeah.
I've been 40 years a bond guy. So I'm going to turn the tides on you, and let's admit it. I've never won a bet with you. I think I did at least 4 beers.
This might be the first one. This is not a bet, by the way. This is just fun.
No,
everybody that's here.
Exactly.
It's funny because the reality is, and I think everybody here knows this, we can all say, I think that XYZ is going to happen.
Absolutely.
And at the end of the year, you're probably going to get some of it's going to come true, some of it's not, and hopefully we've just traded our way through it and made money by the end of the year. But I like to do it because I come up with my, I guess what I believe will happen, how these dominoes are going to fall. And of course, with Trump and every new administration department, because they're all new department heads, it makes it very difficult. We just have no clue how it's ultimately going to pan out and the chaos or euphoria that may ensue. So it's just a guess for fun at this point. So don't worry, we're not going to hold it to you.
We all have opinions. So let me ask you, within my wheelhouse, as your opinion, do you think we'll hit 5% or 4% next on the 10-year?
I think that we're going to hit 5%.
We're at 4.5. We'll hit 5.
I think we're going to hit 5%.
You and I are on consensus. That's no fun. We're never on consensus.
Well, I have a good teacher. I have a good teacher.
No, I really am fervent. I think long-term rates are going to continue the upward momentum we had last year for exactly the same reasons. So,
I
the
think
Fed.
the trend is your friend until the bend at the end. I mean, that's a big one in my book. And you look at the yield since September. I mean, we were down at 3.6. We peaked out about 4.8, and now we're still trending up. Now, it does look like there's on the 10-year yield. I'm a technical analysis person. It does look like there's a head and shoulders pattern forming right now, which means we could see a pullback, and that could be manipulation by Trump and the administration. But long term, the dollar's going to continue to rally up. People are going to buy the dollar so they can get the yield. That's more demand for dollars when an environment when the Fed is removing them. I just think you've got more demand for the dollar than supply. So ultimately, that'll push the dollar up. That'll push yields up as well.
Yep. Absolutely agree. And again, I'm also going to come back to two other factors. Number one is that tapering. The fact that the Fed is tapering does put upward pressure to long-term rates. And we're still, I'm going to sound like a redundant phonograph. We also have the supply issue. We're still getting hit with boatloads of long-term bonds being auctioned into the market. So from a supply and demand, and then the last one is the growing expectation that maybe we don't have inflation under control.
Yeah.
And that wavers number to number. But those were the four factors that drove long-term rates up last year. And every one of those is still a factor. So
Yeah.
I think the move will continue unabated until we, see what's happening with the inflation phenomenon, particularly with these potential tariffs.
Absolutely. And I don't think anything moves from one point. I think there's a misconception that things move in a straight line in financial markets, and they don't. We saw that inflation slowly tick up and then it accelerated. Now all of a sudden we saw it come crashing back down. I'm in the camp of we're not out of the woods yet. I think, and of course I'm not an economist, but I do think it was a mistake to cut that 100 basis points. I think they should have just held it there for as long as possible without really having any issues. But they cut a whole full 100 basis points. I mean that to me that put us back on track for more inflation. Plus, you look at the tariffs going to be imposed this weekend, 25%. Who's paying that extra 25%? You pointed it out. Yeah. It's you and me.
Exactly. This is a tax. Call it what you want. It's a tax. And it's a tax either the corporations are going to eat it, which is not likely. That'll reduce profit margins, or they're more likely going to pass it on to the consumer. That's inflationary.
Yeah.
We're already concerned about food prices. Wait do you see what happens?
Let me ask you this. With Trump the other day, he made a comment, which I thought was very interesting. And again, this is not a hater. It was interesting to hear it said that he wants to remove income taxes for all Americans and make up for it all with tariffs. Now, I've never heard of something like that here. What do you think that impact might have?
Forgive me. I think it was an absurd recommendation.
Okay.
Because what we're saying, the good news is the individual consumers will have more money. They're not going to pay taxes, I guess. The bad news is the prices are going to escalate dramatically. Like I said, a tariff is a tax. Call it what you want. The tariff is a tax. So if you're saying you're going to reduce income taxes but increase tariffs, you're just moving the tax from one column to the other.
Right.
If you're going to do that, I would even throw out, and one of President Trump's Fed nominees last time when he tried to get a couple of interesting characters on the Fed. One of them was, and it was worthy of a comment, what about a VAT tax? What about a consumption tax?
Yeah.
So we'll see. There's opportunities, but please understand, a tariff is a tax. Call it it's a tax.
Yeah. All right. As far as the yields go, we've been looking at that 10-year yield. That's been moving on up. You think 5%. Now, would you call that 5% kind of normalizing and getting back to a normal? Because if I look at this 10-year yield on, I'll bring up a monthly here for the viewers out at home. We've been in a steep decline since July of 1981. And that bottomed out in 2020. Now we've spiked back up here a little bit, and certainly gotten a little bit higher. And grand scheme of things, I feel like we're kind of getting back to normal.
Yeah, and in eco jargon term, they love referring to that as the neutral rate. When the talking heads on TV talk about the neutral rate, that's really what they're talking about. What is that interest rate that will help our economy grow and yet not present economic burdens? And most people, when they talk about a neutral rate, there's two ways to look at it. One is the overnight Fed funds rate, what the rate the Fed directly controls. But then there's also the concept of, okay, looking at the 10-year, because so much is benchmarked to the 10-year. Mortgage rates benchmark off the 10-year. It's the most common maturity for municipals and corporate bonds. So the 10-year has particular significance. So we talk about a neutral rate for the 10-year. And I wouldn't disagree with you that 5%, if we assume that inflation is running at 2 to 3%, 5% on a 10-year is logical, right? You want to be compensated for that level of inflation. So I think we're seeing long-term rates continued their upward movement. Short-term rates is going to be a function of what the Fed decides to do, and that's going to be directly inflation related.
Right.
I mean, I could even see a scenario where the Fed has to raise rates before they cut them. I mean, I'm not saying that, but there is that potential. Absolutely.
Yeah.
Inflation sets that up even a little bit. The Fed's going to be forced. I also think I want to go back to the 50 basis point cut that you mentioned, because I agree with you. That was an unwarranted 50 basis point cut when you look at just the U.S. economy. I think what we're going to find, again, who knows, but I think what we're going to find is that was really international pressure.
Yeah.
If you remember, most other central banks at that time were cutting. And I think the U.S. really just played along, because if we didn't cut while everyone else was cutting, that would overvalue the dollar even more.
Mm-hmm.
So I think that was where we were playing ball with the rest of the rest of the central banks, quite frankly. The 50 basis points was unwarranted.
Yeah, well, you had there's our Fed funds rate, as you guys can see. So we've had that steep 50 basis point, then a 25 and a 25, and now we're kind of in this holding pattern. Let's scroll back to what happened with Canada. Here's your Canadian rates. Notice that they have been aggressively cutting. They were up at 5%. Now they're at 3%. So, I mean, they've cut 200 basis points since, when was that? April of 2024. So less than a year, they've already cut, 200 basis points or 2%. That's pretty significant there. And then let's go to the other one here, which happened today. Here is your ECB. And they're also cutting aggressive. They were at 4.5%, and now they're at 2.9. So very quickly dropping their rates. But, look how long they were at zeros. They were at zero for a very, very long period of time. Actually, slightly negative, I guess you could say, at 0.1.
But our doing nothing is really a statement in and of itself, while the other nations are having to cut.
Yeah.
As I say, it kind of is. I hate the term, but I use it a lot. American exceptionalism. Mm-hmm. We've come out of this. Our philosophy of spend worked.
Yeah. Well, there was some comments that came in here earlier. I do have to get to that point here. I was talking, Lisa says, people are spending. Has anyone considered the use of credit cards for all that spending and the outstanding debt on those credit cards? Yeah. We could look at some of those charts here. Since we did have earnings on Visa and MasterCard today, but you look at the price charts. Here's a monthly of Visa. I know you can't see this one, Bill, unfortunately, but just so you can, I'll read you the numbers. In 2008, Visa was trading at $12. It's currently at $347. So really, since those lows in 2008 to where we are today, Visa's had a run up of 2,516%. No, they're not making any money off of these fees. And how about MasterCard? MasterCard's a little bit worse. Back in 2008, that same period of time, it was trading at $38, $39. Right now, we are at $715, which would be a 1,700% gain. But at its peak, just a few months back, you're over 2,000% gain on MasterCard. So, credit card companies, I'm kind of mean towards them. I hate them. I think that they are destroying people's lives. But let's be honest, they're just providing a service. The reality is, if these people were smart, you would not ever carry a balance on your credit card when it comes to payment day. Pay it off in full, automated the whole thing, and then I use my credit card for every single purchase I make. I don't know if you do, Bill, but I rack up points and miles and discounts.
Absolutely.
Why not?
I'm a points guy. Yep. I'm a points guy. But I would, to Lisa's point, though, I would point out, and this is kind of ethnocentric to the U.S., we love debt. We're comfortable with it. We live on credit cards. But because of that, so much of the U.S. economy is based on the consumer. 65% of GDP comes from the consumer. So to Lisa's point, one measure of how the economy is doing is the delinquency rate on those credit cards. Mm-hmm. She's right. The net amount is going up. But I have to say, and I haven't looked at it in the last 2 months, the delinquency rates are not going up. We seem to be able to support that level of debt for, although it's higher than much of the rest of the world on a consumer basis. It's not, the delinquencies are not getting worse. And that's what the market really focuses on, not the net amount, the delinquency rate.
I was going to actually try to put it on here. I just don't see where that category is. Let's get miscellaneous and speeches out of here. Consumer service. I was going to see if I could find the delinquency numbers coming through here, if there was any sort of delinquency. Spending is increasing, which of course comes as no surprise. Let me go back last week. I think that there are starting to see slightly higher delinquencies, but
Is it?
I'm
Okay,
trying to find it
attention.
here. Unfortunately, I'm not finding it. Of course, every time you want to do something, you want to see something live, it's always going to be slow.
Course.
So let's see.
But that's an important metrics to Lisa's point, is how are we doing?
Yeah. Consumer credit actually on the previous month, if we go back, and I'll bring up the chart here, this is the amount of consumer credit increasing month over month. It actually contracted. It actually contracted by 7.5 billion in the month of January, which is interesting because it was exceptionally high back in May of 2022 at over $50 billion worth of consumer, and it seems like it's dropping. Maybe people are actually listening to the experts saying, "Get money off your credit cards.
Exactly.
Don't carry a balance.
Pay it down."
You know,
At 23%, if you can't make money as a bank, you shouldn't be a banker.
29.
You know,
29 for these credit
is that
cards.
what on some of the stuff, really?
It would not surprise me at some point that, and I don't know who it's going to come from, the Democrat side or the Republican side. I'd hope this would be kind of a nonpartisan thing, that they got to look at these credit card companies and go, our current 10-year yield is 5%. The maximum you can charge is double that.
Yeah.
Right. I mean,
I would love to see something for the consumer there. I don't think it's ever. I think that's a wish list that'll never happen. Look at the political contributions the finance industry makes. So you really think?
No, there's no lobbying. Visa, MasterCard, American, they don't spend any money on these politicians. Come on.
Right.
I don't know if you saw Kennedy's comments towards, was it Bernie Sanders? Where Bernie was just grilling him and he goes, Senator, you took the most contributions from pharmaceutical companies in 2022. And Bernie's like, you're all taking kickbacks, guys, both sides of the aisle.
I can confess, I tell the story often. When I was made a managing director at Lehman back in the old day, in my day, I was given a list of those political contributions I was now expected to make with the increase in compensation I got, including, attorney generals for the state of California type thing. New York, I couldn't care who the attorney general is in California. Lehman cared who the attorney general was in California.
Lehman absolutely did care. It's funny, when I first got really deep into trading in the late 90s, Goldman Sachs was the king, right? And it's interesting how that shifted. It's no longer Goldman Sachs. It's BlackRock, is a bigger player globally. But you would see Goldman Sachs employees, it's almost like this incubator where you worked for Goldman, you made a boatload of money, and then they would find placement for you in governments around the world, like on the Bank of Canada board, on the ECB board, like backgrounds in Goldman Sachs. And do you not think there might be a conflict of interest, or at least some preferential treatment towards Goldman Sachs' policy and objectives? It's all a rigged machine. I hate to sound so skeptical, but I feel like it's a rigged machine.
And please don't make that as past tense as you did. I would remind you, Steve Mnuchin was a Goldman Sachs guy.
Yeah. Yeah.
And
the one before him was too, wasn't it?
Exactly.
Yeah.
They talk about Washington as just Goldman South.
Love it.
Yep. And it's true. It's absolutely true.
Is there anything else? I know last time you were talking about some new bond products. Anything else in the kind of the bond world that you find interesting?
Well, if I could, because I'm really trying to stress a note that I'd like to continue here, which is the dynamic nature of what's happening in interest rates. Do you have that chart I sent you with the blue and red lines?
I do.
So that we can see what happened over the year?
I know.
Of course you do.
There you go.
So, I think this chart really speaks 1,000 words. And for people who don't have the background in interest rates, I really want to just take a moment. Because what happened last year was textbook, but it's also rather odd that it worked so well. So if you look, the blue line is where interest rates are today. That is the U.S. yield curve as of last night. And I would first point out, pardon me, I'm choking on the Fed. I get so excited. Excuse me.
The Fed's not choking right now, according to you.
No, they're not. I am, though, apparently. So if we look, the blue line where yields are today, the first thing I want to point out is that dreaded yield curve inversion is gone.
Yeah.
Right? Both the 1-year and the 2-year yields are lower than the 10-year. So after 18 months of the bond market predicting fear and loathing and a recession, never happened. And now we're coming out of that inversion. Again, that's why I say I think the Fed can take a victory lap. But the reason this happened was because of the dynamic nature of the yield curve. So if you look at the red line, that's where yields were a year ago. And you can dramatically see that short rates came down, as we've already talked about, by 100 basis points. Why? Because the Fed dropped them by 100 basis points, right? They own and control the short end of the market. They determine where those rates are, the overnight rate, and then the rest of the market slaves off of that. So short-term interest rates receive the most dramatic yield change, particularly to the downside, because of the actions we're talking about with the Fed. But if you look, any yield beyond 3 years in maturity, rates actually went up over the course of the year, which results in going from the inverted yield curve where we were to the normal. So, we understand why short rates came down, thank you to the Fed. But the real question is, are they going to be bringing them up or down from now? And again, this is the whole data determinant thing. So we could get some interesting volatility there. But in the long rates, long rates went up almost as much as short rates came down. I think it was on this program a year ago, I said, I had to have an unfortunate conversation with a family member who was saying, I was waiting for the Fed to cut rates because I wanted to refinance my mortgage. And the Fed did cut rates and my mortgage rates went up. Yeah, because you're doing an apples to oranges comparison. What happens in the long end really has no relationship to what the Fed does.
Right.
It's a subject of other dynamics. And that's why I think we're more likely to see 5% because of those dynamics that we kind of reviewed earlier. So the point I really try and stress with the OTA group is interest rates are dynamic. There is not, I hate it when the press says rates went up today or rates went down. I just want to throw something at the TV. Which rate?
Yeah.
Exactly. The Fed dropped short-term rates, and 2 of those meetings, long-term rates went up that day.
Right.
So, I just think we owe it to your audience to clarify that all interest rates are not linear. Yeah. It's very dynamic, and that presents trading opportunities.
Sure. And and that's why we all watch the FOMC statement so closely, is its impact on the market is substantial. There's no argument there. It has massive business implications. However, the longer end, which certainly impacts the cost of capital, mortgages, and things like that, that's driven by a supply and demand factor. So, when I'm looking at the short end, it's like, okay, FOMC, what is that going to impact the markets? When I'm looking at the longer term, I have to look at what's the dollar doing. Is the Fed, unwinding their balance sheet certainly has some impact on it because it's going to impact the dollar. Are they doing more quantitative easing? Are they buying more long-term stuff? Are they manipulating things, trying to manipulate that long that yield curve? And that's the more wild card piece. But knowing that we were inverted for so long, it was just a matter of time that it's going to revert back to normal. So you kind of knew the long term was going to go up and that short term was going to come down one way or the other.
Yep. And that's why the steepening trade, which we've talked about on the XLTs and in your class, the steepening trade was where the marketplace, you were doing a spread trade where you wanted long rates to go up. That trade was the winner. And that trade was a layup. Not that anything is a layup. I shouldn't oversimplify. But with the recognition that at some point the market is going to go normal, that spread trade of trading the 2-year against the 10-year has been a very profitable trade. Even for the retail investor, I love the spread trade. Yeah. And the steepener rather.
You like to give a scorecard or rating for some of these central bankers. I know that you thought Powell's done a pretty darn good job. Before that, Janet Yellen, how do you think she did?
I think Janet Yellen was very good, but I think she also is a very political animal. She grew up at the San Francisco Fed. She was, chief banker, president of the San Francisco Fed after working at Bank of America. Then she went over to the Fed. Then the Treasury Department. I think her move from Fed to Treasury was an indication that she is a very astute political animal.
Yeah. Well, she's going to be gone now, right? So she's going to be out. Yes. When Scott Bessent takes over, he has said, first off, he's pro-Bitcoin, so I was very happy to see that. Second,
yes, he is.
Yeah, baby, all of them.
Yeah.
The SEC, the president, VP, I'm like, let's do this. Yeah. But Bessent has been vocal about he wants a weak dollar. So a lot of the pieces you and I have pointed out, at least addressed, do indicate a rising dollar. However, you got a Secretary of the Treasury now who wants a weak dollar, and I'm sure Trump would want that as well because it pushes the dollar value down. That helps exports. That could foster more economic growth. So here we are where the data and the actions currently are pushing the dollar higher, yet you have a Treasury Department and administration that would like it weaker. How do we, what's your expectation there? What do you think Bessent's going to do here?
Markets prevail.
Markets prevail?
Markets prevail. Absolutely. And I don't mean this sarcastic, and this is true of any president. When President Trump says, he wants to see interest rates go down. Well, let's be quite frank. What president wouldn't?
He did. Wait, hold
right?
on. Let's be clear. He doesn't want to see them. He demands
Right.
that they go down. I mean, come on.
He
Syntax is
demands, right.
important here.
You're absolutely right. He demands that interest rates go down. What president wouldn't say that during
Right.
their administration? We know people vote with their pocketbook, and if interest rates are going lower, even if it's resulting in inflation and problems down the road.
Who cares?
So it's such an absurd comment for the president to say, I want, and not any president, to say, I want rates to go down, or I demand rates to go down. The Fed is autonomous for a reason.
Yeah.
And I really think times like this remind me of that. And I'll give you a contrast, which I mention all the time. When Erdogan in Turkey was elected president at the time, he changed the constitution that the central bank reports to him.
Wow.
Directly. And he has fired in the first 3 years, he fired like 7 heads of the central bank because they wouldn't implement political, policies consistent with his politics.
Yeah.
And as we now see, the central bank in Turkey dropped their bank lending rate. I think it was down to 28%.
Yeah.
Because inflation has just exploded. I'm sorry. No matter who the president is, we need a separation of state power between the fiscal policy people, who I say have done a horrible job, right? They were overspending every year since 1954. They're responsible for the fiscal situation. They've done a horrible job. Do you really want those same people responsible for monetary policy? No, they should be independent.
Well,
There's my speech. How's that?
I love it. No, I love it. It's funny because I'm trying to bring up the Turkish inflation rate. I believe it's 44% right now.
Yeah. And the central bank, that's all that's happened since the central bank was brought under Erdogan, and he's just looking at everything from a political lens, not an economic lens. He has no economic background. I think it's absurd.
Well,
so
it's
the
that
Fed
piece
to
of.
be autonomous.
I agree, and there's in many cases there can be a quest for power, and I think the way our system is set up is it should be everybody somewhat working together to reach a common goal. Now, if one side feels that objective or that goal is just completely outside and unmanageable, then you gotta hold the line here, and hopefully we'll see our Fed not give in to political pressure. But it could happen. We'll see. And here's the chart.
We'll see.
What you're looking at here, this is from August of 2024. So this is a little bit late, but you can see I think their inflation rate's down to 44% of what I was reading. But man, it's pretty crazy.
Down to 44%. That's what happens when you get a DC, when you don't have well, that's not the only reason, obviously, but that is one of the risks you get when you don't have an autonomous Fed.
Yeah.
Absolutely. So I won't, no matter who's there. Now, that being said, the president does appoint the chairperson of the FOMC. That's what Powell is. So we are going to get the question in February of next year, is Trump going to reappoint Powell? Is he going to bring in somebody new? We'll still have that question hanging over. But
we'll find
he
out.
hasn't talked to him since the election. That doesn't bode well.
Yeah, I don't know. I personally don't believe that. But, we'll know by the tweets because it'll turn into just hate tweets for the next few months, and then we'll know he's going to be gone. But Margaret asked an interesting question. I thought this was a good one. She says, the Euro version of the Fed, what's your opinion? Is Lagarde doing a good job over there?
That's a great question.
You don't teach for the ECB, so I guess we're safe. We can be
we're safe on
candid.
that. Exactly. No conflict of interest there. And my saying the Fed that can take a victory lap has nothing to do with the fact that they are a client of mine. I will admit that. I have to say that. But I think the European Central Bank has got a tough job because there is still a Bundesbank that is responsible for, German monetary policies and so on. And yet at the same time, Germany is also the largest economic presence in the European Central Bank. So you've almost got an overlay of the two. And I'm looking at Germany as an example. Germany has been very worried about inflation. And last year, they were very vocal that we see inflation as the biggest problem. The European Central Bank was much more worried about economic activity, as they're still cutting rates. Germany's worried about inflation. Germany wouldn't want rates cut if you're worried about inflation. So the needs, I'm sounding like Star Trek, the needs of the many exceed the needs of the few. Germany has to be a part of the ECB, but they also have to recognize their own individual economic situation and central bank authority and operations. And it's a tough tightrope. I mean, in the last 2 years, 3 of the German officers who are on the ECB for Germany have resigned because they felt that debate was just not being addressed. So, European Central Bank has got some real problems because they don't have as much authority as you might think. And yet at the same time, I mean, I have to give them credit. I think the ECB and the euro is still a very daring experiment. I mean, think about it. We had 13 countries that relinquished their sovereign currency. That's amazing to join this unified currency. And quite frankly, it hasn't provided the unification we'd like to see. There's still regional differences. It hasn't resulted in one eco euro. We
Yeah.
still have 13 different countries with their own economies, and yet they still have to try and coordinate with the ECB. It's like trying to herd chickens, as far as I'm concerned.
Yeah, I've mentioned this one before. I when I moved over to Europe in 2001, gosh, it seems so long ago. In 2001, I was interviewed by a Spanish media outlet, and they asked me what my thought was on the euro because they were literally transitioning as I lived there. I started with the lira, and then I moved over to the euro. And they said, "What are your thoughts?" And I said, "Do you want my tourist opinion or my citizen opinion?" They said, "Give me your tourist opinion." I'm like, "This is friggin' awesome." Otherwise, I swear I had an accordion. I still have it with some in there, an accordion file where I've got each country and I could thumb through and grab all the different currencies. And now that I don't have that, I mean, wow, it's so easy for me to go, and it feels so much better as a consumer. And they said, "Okay, what about a citizen?" I said, "That's crazy. I'm German. I work. I go to work. I work. When I say work from 9 to 5, I work. And then I got the Italians. I go to work. I take a cigarette, a break. I want to go on a pause. And then you go to Greece, and they're like, I'm not even going to work. How do you get these different cultures to
Exactly.
have the same work ethic, the same vacation thoughts? It's just, I don't know. I'm surprised it's done so well for as long as it has, but it's hard to bring up different countries like that. Like in the States, we've got our states, and that's fine. We're not so politically, religiously, culturally different from Nevada to California. Granted, you might have more Republican, more Democrat, whatever, but you're not like speaking a different language, and used to having completely different agriculture, and that's your society's built around that. It's yeah, I don't know. I don't say it's around either.
The analogy would more be North America, right? Canada, US, and Mexico.
Yeah.
Getting one. Are you ever going to see that? Of course not. That's what I said.
I don't know. We're going to be invading Canada here soon. Come on, let's just take it over by force.
51st states.
Oh man, I tell you, I apologize. I know my viewers are like, Merlin, you're going too political this year. It's hard not to with these changes, and I'm not going one side or the other. I just think it's going to be exciting. I think we have so much volatility, especially with the bond markets. One thing that you've mentioned in the past, and I'm curious if this has changed. You've mentioned that they are selling record amounts of 10 years to service this debt. So has that subsided at all?
Long term.
Long term, right?
Yeah, no, 10 year, 20 year, and 30 year.
Is it changed at all?
No, we're going to have this phenomenon going on through June.
Okay.
So here's and it's really poor planning by the Fed. Here I do have to take a shot at them. Because if you look of the entire amount of debt that the Fed has outstanding, or the Treasury has outstanding, it's not the Fed, the Treasury has outstanding, there's a huge predominance of treasuries that are going to be maturing in the next 6 months. In fact, if you look at the last 6 months and the next 6 months, of all of the treasuries that are outstanding, 40% of them were going to be maturing in that 12-month period.
Wow. That's huge.
That's huge.
Yeah.
That's huge. So it means even if we didn't have a deficit, the government would have to issue all of these new treasuries to pay off the old ones, right? Because we don't have the money to pay it off. So every time a treasury matures, we have to issue another one.
And extra.
No, that's with even if we have no deficit. Let's say the U.S. government was operating at no deficit, no surplus. Well, that means every time a treasury matures and we get handed a bill, we can't pay it. So we have to issue a new treasury to pay for it. We borrow from Peter to pay Paul. That's the way it works.
Yep.
So 40% of the entire treasury portfolio is maturing in a 12-month period. They're going to have to refinance that by issuing, and they issue now, they've learned their lesson, longer-term maturities. Now add on top of it the record deficits we're still incurring, right? Last year, 1.7 trillion. So that's more money that we have to borrow. So we've got this flood of supply coming into the market between June of last year and June of this year. And we do see, that's part of the reason I, again, think that upward pressure to long-term rates, supply and demand.
Right.
We got this boatload of treasuries. Now, the question that is always to be answered, and we've spent a lot of time on this in your programs, is what does the demand equation look like?
Yeah.
And the good news is we continue to have strong demand for treasuries. Let's
We
be
got one of the
honest.
highest yields. We got one of the higher
Yeah,
yields out there, which just makes us somewhat attractive, right? And someone's looking to earn on their capital, they're going to look over to us and go,
right.
oh, you guys are paying,
And
you're
absolutely.
paying 4.5. I'll bring it up here for you guys can see it. You're paying 4.5%. So if you're somebody over in Europe who's got 2.9%, you may as well come buy U.S. dollars so you can buy the
Right.
10-year and lock yourself in and gain 1.6% delta on your investment. So it will increase
And
demand.
absolutely. And add on top of it, as we were just saying, the dollar perceived to get stronger and stronger. For the foreign investor, that's going to enhance their return even more, right?
Yeah.
Because when they convert their dollars back to the local currency, they'll be buying more local currencies. That's a win-win.
That's a
So
wonderful.
you're getting a higher yield, and you've got, from a risk point of view, what seems to sound like a logical trade. So we have strong demand for our treasuries. I got to be, that's a comforting fact, at least as we sit here today.
Yeah. Oh, well. So much time. One last question, then we'll wrap up here. Liz says, question for Bill: is it true that the Fed is due to run out of money this year? And if so, what are your thoughts? Can they run
Well,
out of money?
that's no, see, and that's the common misconception. Great question. So let me make a distinction. So when the government needs money, they have to borrow it, right? Because they overspend. The government doesn't print money. The government doesn't create money. Common misconception. Our Fed creates and controls money, not the Treasury Department. So when our government during the pandemic overspent by $3 trillion in 2 years, we had to go out and borrow $3 trillion more by issuing $3 trillion worth of treasuries. That's the government operation. That's the fiscal side of things. Now, the Fed is responsible for the monetary side. Now, when the Fed wants to do something, they do have the authority to just create and print money as much as they want. I mean, remember, the dollar's not backed by anything.
Yeah.
Dollar's only safe because we think it's safe.
Yeah.
So, for example, as you know, during the pandemic, in 6 months, our Fed created $4 trillion of new money and dumped it into our economy. That's what quantitative easing was all about. And when the Fed made that decision to dump $4 trillion of new cash into our economy, who in the government had to oversee or approve that decision? Nobody.
Yeah.
The Fed has the authority and autonomy to do it. So the Fed's borrowing capability is endless.
I wish I
quite
had that
frankly.
problem. I would. It'd be so nice
Yeah.
if you could just say, "I want to do anything that I can do," and no one can say no.
Yep. And I would point out that takes us kind of full circle back to where we started, because now the Fed is destroying that money. Right? They're destroying 60 billion. And again, when they made that decision, who in the government had input? Nobody. They have the authority and autonomy. The Fed controls our money. It's a common misconception. The government actually has nothing to do with the issuance of money.
It's just what cracks me up whenever he points the finger at the government. It's just oh, it was
Right.
the government. Like, it was the Fed. Learn how the system works. All right, I know you don't trade. I know that you're not an S&P guy. Do you want to give a prediction, up or down for
I'll
the
go
year?
up 10%. I'll go up 10%.
Okay, let me bring up a spreadsheet here so I can see what exactly 10% equates out to. Boy,
Actually, you know what? I got to go with the courage of my conviction. Down 10%.
wow, that was a flip flop right there. That was a
Yeah,
big
it
flip
was.
flop.
I was being politically correct. I think we're in for some trouble.
Okay, down 10%, and so I'll let you know what my prediction was down 7.49%.
Oh,
so,
wow. Once again, we're on the same side of the coin. Wow.
dang it!
Really?
I'll adjust this so it's 10%, but I have to let's see. This is
Or approximate. I don't
no. Nobody else was at 10%, so I gotta make it perfect for you, and it's just about having adjust these numbers. Let's go. All right, close enough. I'll leave it there, and I'll make this one 10%. And what do you think's gonna happen with Bitcoin? We have a lot going on with Bitcoin. I know you believe it's not really a currency. It is an asset, I guess. But
Absolutely.
what?
I'll go with the asset discussion.
Okay.
I'm going to put Bitcoin at 160,000.
Okay. Well, I was surprised to hear you say that. I thought you'd actually be less than that.
Wow. In the interest of full disclosure, I stress I don't trade it, but I am an owner of Bitcoin.
Okay.
So, I do have a vested interest here. So, yeah, let's go 160,000. I think your bullish case is well founded.
Mine, I've got a 169.5. I think we're actually going to hit 250, but then sell off near the end of the year.
Okay.
But there you go.
Again, we're all on the same side of the coin. Wow.
With great minds think alike. It's good to see.
Really?
For those that may not know, Bill's class at Trading Academy is here. It is called Bonds, the Canary in the Coal Mine. If those of you here are interested, I will copy that link over into the chat for you guys so you can check out that one there. Also, if you go to his website, which is, I've had it, let's see, it's right. Well, I put it on your name on your screen. It's aftraining.co. aftraining.co. He's got some books out there that he had a hand in developing, which are actually very good. You can buy this little 3-pack there. There's also all kinds of videos and other informational pieces. So.
Videos with Merlin. You and I have got a library of videos going back when we were doing those.
Oh, we do, huh? Those are all there? Jeez Louise.
They're there too.
Those are good stuff. Too. Want to learn bond ladders and all kinds of different stuff. There's some good materials in here, guys. And
I want to put a plug in, quite frankly. The next focus class is next Friday.
Oh, okay.
So we've got a focus class, and they run approximately every other month. So we've got the one-day focus on bonds for anybody who wants to do it. That's next Friday.
And I think it's going to be, I think it's an ever-growing important topic. I guess maybe it's just my understanding of it, because when I started in the late 90s, it didn't feel as significant. But now I guess once you understand how big and influential the bond markets are and what it does to economies around the world, it's kind of foolish not to pay attention to it.
Thank you. I agree. But I'm a bond guy. I have to agree. Every asset revolves around bonds. So come on, let's admit it.
It's all bonds.
Every asset category revolves around bonds. It's all bonds.
All right, Bill. Well, hey, thank you very much. I appreciate it. We'll talk to you at the next Fed meeting. And good luck to you and have fun in your focus class. I may have to log in and join that one.
Jump in anytime. You know that. Right. I mean to jump in on your Bitcoin one too, or your crypto one also. So we'll do it together.
Sounds good. All right, Bill. Take care, my friend.
All right, guy.
All right.
Be well, folks.
Guys, that was Bill Addiss. If you want to find out more information, you can go to tradingacademy.com. I gave you a little page there you can check out. He's got his little bond class, which is great. He also does an XLT session. I think he does a general session once a month or so, which is always exciting. All right, let's move from bonds, which are always very exciting, to what's going on in our current market. And I was mentioning the Canadian dollar. Let me just bring that one up here, because when that announcement came out that we're going to slap 25% tariffs on Canada by the end of the week, well, by Saturday, there was an interesting chart formation here. And John Kicklighter, who I've actually interviewed in the past, really bright Forex kind of economist guy, he's pointed out that you've got this ceiling that it's smacking its head against. And the lows, at least since April of 2021, have been getting higher and higher and higher. This is a monthly time frame that we're looking at. So this is actually obviously a very long-term time frame. But I'm looking at the lows right here increasing as the high stays the same. And it just feels like it's that kind of coiling spring waiting to pop to the upside here on the U.S. CAD. Of course, them lowering their rates, that hurts the value of their dollar. We will see what happens here with this one. But it had a pretty nice spike today. Let me bring up your daily here. So you can, actually, we'll do a 15-minute just to watch the Trump pump, the spike right there. There's your announcement. That was a huge spike up there as he made this announcement of we're putting tariffs on him today, 25% starting Saturday. We'll see if that actually does happen, or if that's just the shock and awe that I've alluded to many times. But could create a lot of moves out there in that Forex space. As far as our earnings counters go today, I'm going to really just quickly bring this one up here as a summary so you guys can see the earnings front. You had Apple report earnings, and really most of these companies beat. I hope I did not make any mistakes here, although I very well could have. No. All these companies beat on earnings. So you have Apple, Intel, Visa, MasterCard, Caterpillar, Altria, Valero, Northrop Grumman, UPS. They all beat earnings. Now, some of these were down in price. So you can see, even though they beat earnings, you had Caterpillar and Altria, Valero, and UPS down on those earnings beats. So let's go look at some overall pieces here. And of course, we've got a big one happening after hours right now. That is your Apple price chart, and there it is. I'll put this on a 5-minute so we can see the action happening. Started off on a really weak note, and all of a sudden, boom, it just ripped to the upside there on their conference call. I'd like to see what they said that caused that little surge. Shot up 3.25% on that announcement. So it started off weak and then really started to rip. You had Intel, right? Started off strong and continuing its strength in the after-hours session on their earnings announcement, currently up 3.2%. Visa was up 2% on the day, up 1.45% in the after-hours session. Same with MasterCard. So a lot of MasterCard. Oh, this isn't. Why am I getting a totally different? real quickly. I was not coming up as MasterCard. I had MA. Oh, I had MC. I knew I had it in there wrong. MasterCard was up on the day, but just barely up in the after-hours session. And I guess last one I want to look at here is going to be Northrop Grumman. Let's see. Let's go to Northrop Grumman. That's going to be NOC. NOC for you. They are up after hours, but not that much. Again, a lot of these NYSE securities, and again, Northrop reported before market open. A lot of the NYSE will report, actually all NYSE typically reports before market open. Pretty crazy. Market says, Merlin, can us trade AAOL options? I do not know. I don't know this security, never even heard of AAOL. But I don't even, AAOL? Am I missing something here? Because it's not even showing up as a stock. So I don't know. I had some issues yesterday with my TradingView platform. Not quite sure what was going on. Are you mean Apple options? No Apple options. No, there you go. I thought you were talking a different stock. Let me go back to the daily here, and I will run this through just so we can see real quick what's going on, and then I'll wrap up before I do a 1 hour show. I'm not doing a 1 hour show today. Don't try to bait me with questions, people. I see what's going on. We already looked at that 10 here. Still a little bit weak, down 0.26% on the day. You had crude oil with a nice little, tiny little pop of 0.15%. At least it was positive. Your dollar index, a lot of the stuff didn't have the greatest moves today. I am interested to see what continues with the dollar. Again, I'm bullish on the dollar. I think that that's the trend you got to ride here for at least for the short term. NASDAQ, you had NASDAQ up 0.47%. When we look down at that magnificent 7, that was part of your reason today, even though you had Microsoft down big. Microsoft was down 6%, but Tesla dragged it up, Google dragged it up, Meta was up 1.5%, and where was my Nvidia? Nvidia 0.77% on the day. So some of the big tech names doing well, even though Microsoft did not look so great today. Although, where's it back to? It's back to where it was 2 weeks ago. Not like a big fall at all for Microsoft, and still maintaining this uptrend in my opinion. Moving to the top of our list, that was the NASDAQ I kind of finished with there. I've got S&P up 0.52. What's the story here? Song remains the same. Long and strong, you're coming towards all-time highs, but it does feel like momentum is still moving to the upside. Bitcoin, same picture, although it looks even stronger today. You had a nice little green candle. My guess is all-time highs right around the corner, probably by the end of next week. I think tomorrow will be a bullish day, but I think when we get into Monday over the weekend, we'll see more upside movement there for Bitcoin, putting it into all-time high territory again. Russell 2000, technically, I got nothing to say. It's trending up, but it's just real clear direction of overhead supply until we get to about 2360. And then I mentioned that I thought we would see gold make all-time highs here real soon, maybe by the end. I think I maybe said by Friday. Well, it came early. 2.72% gain for gold today, up to 28.45 in the after-hour session. All-time highs yet again. I don't expect this trend to stop either. I think this is going to continue on to the upside and continue to look great for gold going forward. All right, last piece. We'll go look at earnings calendar just because tomorrow there are some names reporting earnings. You got AbbVie, ExxonMobil, you have Chevron, Phillips 66, Novartis, Colgate-Palmolive. That's your big stuff. But really the big news is going to be what happens tomorrow for the U.S. markets. You can see here we have, that's 2 weeks out. Let me go forward to tomorrow. Here is tomorrow's stuff. You've got the core PCE price index numbers. That's really important, everybody. That is really important. Obviously, that's the inflationary number that everyone's focusing on. The expectations are it's going to go from 0.1 to 0.2, which is we've been kind of stuck down these low levels. So we're going to start to maybe see some incremental jumps up here in inflation. For the U.S., that's pretty much it. You have personal income and spending as well. They're expecting to see spending go up as well as income. So all in all, should be a decent day tomorrow. So that's going to do it for me. Hope you guys enjoyed that one. We're not going to do an hour show. Tomorrow, I'm back on the sauce. I actually received a wonderful bottle. I actually thought it was a rum, but it's a whiskey in rum barrel. So I will, oops, hold on, Tony, hold on. Got to hang up that real quick. I will show you that one tomorrow. Of course, if you have any questions or anything, you can email me at tradermerlin@gmail.com. Let me know anything you guys want to discuss for tomorrow's show. It is wide open. Hope you enjoyed Bill Addiss. Check him out at tradingacademy.com. That's it, everybody. Have a fantastic remainder of your day. I will see you mañana.